Hello, chart watchers, and welcome to this Tuesday, May 21st, 2019 Market Watchers live show with your hosts, Tom Bowley and Erin. For those of you joining us for the first time today, welcome to the show, and for our regulars, welcome back. Let's take a look at what's going on in the market today. We are seeing a rebound. You can see the Dow Jones Industrial Average currently up 125 points, although it is off the earlier highs of the day. S&P 500 up 20. The NASDAQ up 74, the Russell 2000 up 17. So on a relative basis, small caps doing pretty well today. 10-year Treasury yield moving higher once again, up about 1.5 basis points, now back to 2.43%. This is the highest level we've seen in the last 7 trading days. So good news there in that money is rotating away from Treasuries. Volatility index continues to move lower, also a good sign despite the selling yesterday. Today's recovery, you can see the VIX now trying to push back and actually on an intraday basis moved to about a 2 to 3 week low earlier today. Materials leading to the upside. Also, you can see energy doing pretty well. Very surprising considering that the UUP, which is the proxy for the dollar, breaking out to a new multi-month high here. So kind of interesting to see materials and energy on the upper side of the sector leaderboard. Technology here, you can see also having a very strong day, moving back up, but still some hurdles, technical hurdles to try to overcome. One industry group having a really strong day, renewable energy. So included in that energy space over here is the renewables, and renewables having a strong day, moving back up above their 20-day moving average. A couple other groups I wanted to mention, Biotechs. Still got a lot of work to do here, but Biotechs, I'm watching this 1900 level, getting back up above the moving average, and also an area where we had broken down previously, I think would be a very good sign for the biotech. So keep an eye out there. Home construction also rebounding, moving back above the 20-day moving average. Found this interesting, given the existing home sales that came out earlier this morning that were weaker than expected. A couple of companies reporting earnings. Home Depot gapped down after their earnings, but now rallying back, still down about $0.50. But not bad considering where it was earlier this morning. Kohl's, that one too has bounced back from the open, but still way down today. Stock down probably, 12% or so after missing on their top line and bottom line and guiding lower. So the trifecta in a bad way for Kohl's this morning. All right, Erin, it's Tuesday. It's my birthday.
Yes, happy birthday, Tom.
Thank you.
Hopefully you'll be celebrating in style.
I will be celebrating on the golf course this afternoon.
Excellent. Where else would you be on your birthday? I can't imagine.
I can't either. I mean, that's where I'm supposed to be.
Mm-hmm.
Where I was designed to be. So what are you going to do today for my birthday?
What am I going to do for your birthday? I think maybe I'll go to the gym. I know that sounds so exciting.
Well, maybe I'll lose weight.
There you go. I'll take care of that for you. I'll do the work, and hopefully that'll transfer over to you across the country.
Yeah, I kind of feel like it probably won't, but I appreciate the thought. It's the thought.
Well, at least the markets are doing pretty good today for your birthday.
Yes, they are. Nice little rally, always nice. And my birthday happens to fall in that bad period. Right from the 19th to the 25th of the month, calendar month, which is when we tend to see the market weak. So I don't get to see a whole lot of strength on May 21st each year. So yes, it's nice.
Exactly. All right. Well, I'm going to go into that upcoming schedule. I know you do have your workshop. And as we were just saying, happy birthday.
Oh,
that's excellent. Larry Pesavento is going to be with us tomorrow. Julius de Kempener, Mr. RRG on Thursday. And we will all have a little break. The stock market is going to be closed on Monday for Memorial Day, so we won't be having a show that day. Today, we do have a show, and we are going to start off with Tom's workshop, My Trading Plan, 10 and 10. Our first symbol will be WW Granger, and the Scooter Report will finish off the show. So let's go ahead and get started. Technical news and headlines.
Yeah, there wasn't a whole lot, especially in terms of economic reports. But as I mentioned earlier, home construction having a pretty good day today, despite what you can see on your screen, which was April existing home sales coming in lower than expectations. Now, keep in mind, this is April. We're looking at April, and we're now almost ready to head into June. So a lot of these home construction reports are lagging. So the market tends to look ahead. So maybe the market doesn't care about what the April existing home sales were doing, but I always find it interesting when I see the market reacting opposite of what I would expect based on the news. As far as the response in treasuries and in the treasury market goes, you can see here that we have gapped up nicely. I've been mentioning over the past couple of days these hollow candles where initially there's money rotating into treasuries, which sends the yield down. But by the end of the day, the money comes back out of treasuries, sending the yield higher. And we keep printing these hollow candles. So I think that's a pretty good sign, especially at support. So I'm looking for a little bit of a rally here. I think now we've established clearly 2.36, 2.35 down in this area as major yield support on the 10-year treasury. And then you come back up here and that reaction high was at 260. And I think it was also on the weekly chart, if I'm not mistaken. Let me pull that up. I think 260 may have been, yeah, there's your 20-week EMA, which currently is at 2.583. So just remember, if we get back up above 260, and I know we're still a long way away from there, but if we were to do that, I think that could be a game changer here on the weekly chart, because that 20-week moving average has been holding the yield below that level now for the past 6-7 months. And so getting back above that, I think, would be a big deal technically. And again, looking at the daily chart, getting above 260 would take out that April high. So I think that the battle lines here have been drawn in the treasury market, and we'll see which way we go. Now, if we move back to the upside above 260, I definitely view that bullish for the equity markets because we don't have any inflation. So the only other reason that the 10-year treasury yield would start moving higher would be the expectation of a strengthening economy. To the downside, it could go either way. And I know I'm saying this a little bit from a bullish bias, but I am bullish long term. But I think a breakdown at 235 could tell us one of two things. The bearish argument would be that, okay, the economic outlook has deteriorated, and that's why money is rotating into treasuries and yields breaking down. But I'm believing that the treasury market is sending the Fed a message that because we've got a strengthening dollar, and because that strengthening dollar is keeping a lid on commodity prices, we have no inflation, and our bigger fear is deflation, and it's time to lower rates, not raise them. I think that's what the treasury market has been saying. So I think if we break below 235, I'm still going to want to see how equities respond to it. If we go above 260, I don't think there's anything but bullish news for equities going forward. So something to think about as we move forward. All right, earnings news, and we had a bunch of earnings news out today. You can see them on your screen. Won't go over each individual one, but I will start off looking at Home Depot. So let's pull that one up. Want to mention also Toll Brothers reports after the bell today, as does Nordstrom's. Nordstrom's really has struggled for quite some time, and Toll Brothers being part of that home construction group that's been under, it's been on fire really of late. So looking for a good report maybe out of Toll Brothers. Anyhow, Home Depot. When I was looking at the relative chart of Home Depot versus Home Improvements, average kind of comes to mind. I mean, yeah, the last couple of weeks we've been moving lower, getting closer to that 52-week low. But when I just look back over the last year, I don't see any real leadership here in Home Depot, and that's probably not a good sign for the overall group, which has been downtrending now for the last 5 weeks or so. We did come out with the news. Home Depot beat on the top line, beat on the bottom line, guided their fiscal year 20 revenues higher, and the stock gapped down. We had opened, let's see, we're down, we were probably down about $4 on the open. Now we're down 50 cents. So we are seeing some buying come back in. Volume's heavy, as you would expect with a big earnings announcement. But there's some work to do here. I think 105, you can see these recent tails up, 195. 195 with those recent tails, that's where sellers have come back in. Also, you can see your 20-day and your 50-day moving average sitting right up there near 195. So Home Depot's got to get through 195 before it would begin to interest me. And with that, I'd like to see the relative strength begin to build and maybe ultimately move back up here above these highs to set a multi-month high. Till that happens, I would pass on Home Depot. Not really overly excited with what's going on here. Kohl's, I wanted to bring this one up, just show you quickly that the move has been to the downside recently. Look at the relative weakness in Kohl's versus the apparel retailers. Look at the apparel retailers down at a 52-week low. Kohl's being one of the worst, even before the announcement came out. So when they come out and they miss on their top line, miss on their bottom line, and they guide lower for fiscal year 20, you should be able to go to your friends at a party this weekend and say, I knew they were going to report lower. Just look at their relative strength. And then after they call you a psychiatrist, you can go on and enjoy the rest of your party. All right. A couple of other things I want to mention before we get into upgrades, downgrades. A trader's worst nightmare, one of my worst nightmares, earnings I can predict. So I know when the earnings are going to come out, so I don't have to stay in. I don't have to have that kind of risk. But when you get this kind of risk, MRCY, I was just talking to John Hopkins yesterday. It was on the 20-day, and you can see how the 20-day has been holding. I was just talking to him about how good the stock looked. I didn't buy anything in MRCY yesterday because at this time of the month, I'm just a little nervous with the market. But if I had bought that, this would have been a stock I would have bought yesterday off the 20-day. Today, they come out with a stock offering. And you never know when these stock offerings are going to come out. But this one was 5 million shares. And at its current price, I don't know where it's going to be priced at, but at its current price, it's $350 million. This is a $3.5 billion company. That's 10% of its market cap. That's some pretty serious dilution. Doesn't mean it's a bad thing, but it's dilution. So if they just take that $350 million in and put it in a bank account and they don't really earn anything with it, all of a sudden you have 10% more shares with no increase in earnings. So your earnings per share goes down. So a lot of times the dilution drives these stocks lower. It drives me crazy as a short-term trader because many times you have no idea. And it usually happens to companies that are trending higher, which makes common sense. Because if you've got a higher stock price, you're going to be able to give fewer shares. You're going to have to sell fewer shares to get the desired amount of money. So many times after companies come out with earnings, they will come out, and the stock gap's up. Everybody's jumping in. Everyone's excited. And then the next day or two, you come out with a stock offering that kills them. But this wasn't the only one, by the way. CVNA came out. They're only 2% of their market cap. So they rebounded pretty quickly after gapping down. Guardian Health, GH, another strong company that had moved up tremendously earlier this year, sideways consolidating, starting to strengthen a little bit. 5% of their market cap. Stock's down 3.3% today. 5% of their market cap in a stock offering. So anyhow, just want to mention it because this is frustrating to me as a trader. Maybe many of you have been caught in these before as well. But with that, Erin, let's go ahead and go into the upgrades, downgrades.
All right. That sounds like a great plan. I have 6. We're going to look at 4 upgrades and 2 downgrades. So let's go ahead and get started. Our first upgrade is from B of A Merrill to Ambev, ABEV. It was upgraded today from an underperform to a neutral with no target. You can see we made that short-term $4 support level. Kind of lines up with a couple of lows we saw back in November. But we got the really nice bounce. Of course, it's up over 4% on this upgrade. What I'm really going to be curious about is to see what happens to the OBV today. Right now, that's some pretty good volume going into the day, where we're at in the day. But I'd really like to see a big bar here that will help take out the height we got on the negative over here for volume. And that would bring our OBV back up. I'd like to see it get back above at least this previous kind of top we had here on the OBV, just so I can really feel like this is a move that isn't just about the upgrade or some such thing. At this point, we do need to get above that 420 level, and right now we are trading above it at just barely at 421. Next one up, Polaris Industries. Polaris Industries was upgraded today by BMO Capital. From a market perform to an outperform. They raised their target from $96 up to $99. And I find it interesting, just when I looked at the technicals, what I noted first was a very short-term double bottom. And if you took the measurement, and if we get the breakout and it is indeed a double bottom, the minimum upside target would bring us right about up to hey, $99, which is what they have printed as their target going in on this upgrade. But also I wanted to point out this rising trend channel. If I had brought this down, it would have lined up pretty well too right in here. It was just more of a wedge, but in any case, it looks like a rising trend channel. We could be making our way back up to that top level, get the breakout. This one's certainly one to watch. The PMO is already trying to turn back up on this move. Next up is Stanley Black & Decker. Stanley Black & Decker was upgraded today by Zelman from a neutral to a buy. Again, I saw a little tiny short-term double bottom. In this case, the confirmation line is a bit higher because we have the middle of that W hitting right there at about 142.50. So when you do the measurement on this particular one, you end up with an upside target right around the top that we saw earlier in May. PMO hasn't quite turned up yet, and it did move into the negative zone there. 20 is trying to get down here and cross below the 50. I think it's on the edge. This might be the best time for it to make that move to the upside. Everything's sort of stretched out. I think we can get above that 20.50. If we can do that, of course, that would get us into that pattern and the execution. So I think this one, Stanley Black & Decker, might be one to pay attention to. TripAdvisor. TripAdvisor was upgraded today by Guggenheim from a sell to a neutral. They did not list a target. And you can see we made this short-term bottom. The PMO is slowing down. I think that's great. I marked this because this is the gap that we're going to be watching for to see if we can come back up and close it. Right now, though, this is really a declining trend channel, and we're at the top of that channel. So, we were seeing that upgrade. One thing I wanted to point out, Tom, because I know you talked about booking. I'm not so sure what you had talked about as far as seasonality for TripAdvisor, but notice right here, March, pretty much flat. May, we're having a really bad May. So I just thought it would be interesting to look at seasonality, because if I recall, those tend to do better in the spring. So here is the TripAdvisor seasonality. And March, 70% of the time, it's going to be, 4.6 higher. And so if you recall, we ended up flat. So we didn't really come through on that particular seasonality tool there, the seasonality bias. In May, coming up, or what we're going through right now, it's supposed to have a really good month in May, typically. Of course, seasonality is, it's really, I look at it as confirmation or interesting information. So let's go back to that chart real quick here. And there we are. So remember, March, pretty much not much of anything. And May, which usually has a really great performance, we're seeing really a deep decline here. Now we've got the PMO, like I said, it is trying to turn up. But you've got the scooter is really low. OBV, it didn't deteriorate to the degree it could have once it made this big move down and continued lower. The OBV didn't really get hit too hard, and I think that could be a positive for TripAdvisor. But, be careful with this one. I'd really want to see the PMO turn back up, but this really looks quite oversold. And I think that there is an opportunity to at least come up here and challenge the overhead resistance at about $50. So possibly that's what Guggenheim was looking at, that at least we probably have hit the bottom, and they've moved into a neutral position. So I think they're just looking for either some consolidation or maybe some trading within that 44 to 50 zone. All right, now let's move on to some downgrades. Gran Tierra Energy, GTE. This is in the exploration and production area. Been in a pretty solid trading range. Oil has too. And, it's pretty much down to the bottom of that trading range, which I think is certainly a positive. You can see that the PMO has turned lower below its signal line and is continuing lower. No scooter for this one, but OBV, it did flatten out here with the flat price. I'm not seeing that much improvement here, but the fact that it has been in such a trading zone all year long, I'm not looking for the breakdown here. It is a downgraded today. Let's go ahead and look at the weekly chart to get a little bit better take on this. And there you go. We've got the PMO sell signal. You can see how important this low is, especially when you're talking about a $2 stock. But there's certainly room for it to fail below the support line and then make a turnaround. There's your low back here from 2017, which looks like it's about $1.85.90. And down here, we've got that $1.75 level. So if we fail here at $2, I'd look for $1.75. It doesn't look great, but I think that it's so oversold that this one might be getting ready to make that move. Occidental Petroleum. All right, this one was downgraded by Wells Fargo today from an outperform to a market perform. And I did want to mention with GTE, it was RBC Capital. Here, I'll go back to that chart so you can see that one. Okay, so it was downgraded today by RBC Capital, and this was a distinguished. I haven't heard this one, but it went from a top pick to outperform. So they're expecting it to do well, but wow, I wonder when they made it a top pick, because maybe they got in here and got that move. It is a lower price stock, but I thought that was interesting. They're still looking for it to outperform. They are looking for a move off of that $2 level for sure. So even though it was downgraded, it was only downgraded. I mean, it was downgraded to an outperform. So it should be doing well. All right, so let's move on to Oxy. Right here. All right, Occidental. Wells Fargo downgraded it from an outperform to a market perform. No target here. PMO is still in decline, but certainly very oversold. And then let's go ahead and take a peek really quick here at the weekly, because you can't find support on this daily. And there you go. We're looking at $52 as a support level. Look at this PMO. It's seeing prices seeing readings we haven't seen since 2012. Possible gigantic head and shoulders here on the weekly chart as well. So Oxy, I have to say I'm in agreement on that downgrade for sure. All right, let's look at the downgrades, upgrades we had today. I did want to mention on the bottom of this chart, Credit Suisse initiated coverage on 7 biotechs today. So I will be actually concentrating on biotechs at the end of the show as part of the Scooter Report. I want to see what Credit Suisse is seeing right now. All right, Tom, let's go ahead and I'll pass it to you for your workshop.
Okay, sounds good. I'm going to go ahead today and just share with you my trading plan and the things that I do. I know, I think it was Dave Keller that we had on here once earlier, and he talked a little bit about that, about having a plan and trying to be consistent in how you look at the market and so forth and be disciplined. So I thought I would just give you some thoughts on how I approach the market, both on a long-term basis and short-term basis. So let's start off with the big picture, because for me, I can't even think about trading the market until I have an overall belief in which way I think the stock market's going to go. And if I don't know which way the stock market's going to go, then I am probably going to be sitting it out. Probably will not trade a whole lot, try and maybe hit 1 or 2 stocks here or there, but I'm not going to commit a lot of capital if I'm not sure which way I think the market goes. So the first thing I would do is simply from a big picture perspective is look to see what I think is going on in the S&P 500. Are we in a secular bear market or are we in a secular bull market? So the first thing here, when you look at these red shaded areas, the stock market, this might look like, oh, we just went through a little bit of consolidation. Well, this little bit of consolidation right here was from 1969 to 1983 or 2. So 13 years of going nowhere. I mean, yes, we had bear market, bull market, bear market, bull market, but essentially 13 years of doing nothing. That is a difficult market to simply just sit and just keep trading on the long side and not making any adjustments in your trading strategy, because it works for a couple years and then you get clobbered for a couple years. And then and by the time you get clobbered, you're so sick of the market, you don't want to be back in anymore. And then it starts working again. About the time it starts working, you start feeling good about the market, you start jumping in, then it goes nowhere again. Very difficult. It's important to be able to identify, are we in a secular bear market or a secular bull market? Now look at these other periods where I have these circles. The circles are identifying weakness, but this is cyclical weakness in a secular uptrend. And so the difference between these pullbacks and these big bear markets, I think you can see, are pretty, there's a lot of difference there. You think back to 1987. Yeah, that was a crash, but it came after almost a parabolic move to the upside. So the crash, when we look at it in context, wasn't really that bad at all, considering where the market went during this secular bull market. So when I say I'm bullish, I'm not just saying I'm bullish because I'm always bullish. I tend to be on the bullish side unless the market beats me over the head with some negative action and bearish. You get into a secular bear market and you can't help but be bearish. But I think after the 12 or 13 years here, very similar to the 12, 13 years here, sideways consolidation, big bear markets, deep bear markets, rallies, another deep bear market, I think we broke out. And notice when we broke out of this one, we didn't just go up for a couple of years. This was an 18-year move to the upside. After we broke out, we went another 18 years. So I'm not measuring from back at the bottom. See, I think some folks look at this and I think it's a mistake to go back to the bottom and say, well, we're already in we're in our 10th year or 11th year. I don't know that I would say that. I think, we were still trying to break out of this. I think we actually broke out in about 2013. So when I look back here where we broke out, again, not measuring from the bottom, but when I look at the breakout here in 1982, we had another 18 years. When we went sideways here and broke out in 54, we had another 15 years. This going sideways and breaking out, if we have 15 to 18 years from here, we're going to be talking about the late 2020s or maybe even 2030 before we hit the next secular bear market where we might expect for a dozen years of going nowhere. That's why I'm so bullish right now. I think the market's going to go higher. I think it's going to go a lot higher. I think history suggests that we're going to go higher. And so now what I'm looking for are these little red circles where we're just getting pullbacks. I could have circled this one right here, 1998. That was about a 20% drop before we went up one more time. But these don't last as long as these huge declines. I think too many people are still focused on this bear market, secular bear market that we are in, thinking that we're going to do that again. I do not think that's happening. I could be wrong, just my opinion, but I don't believe that's the case. I think after going sideways for 12 or 13 years, I believe that we are poised for a long-term extended secular bull market. And so these pullbacks, as scary as that was back in the fourth quarter, I think it was an opportunity. And I think it continues to be an opportunity even now, having rallied as much as we have in 2019. So that's step one. I believe we are in a secular bull market. Step two, what sectors or industry groups are leading to the upside? Actually, before I even get into that, let me pull up the S&P 500 here on a weekly and daily chart. So the long term, I'm thinking we're in a secular bull. Weekly chart. Now, we had broken down. This turned out to be a cyclical bear market, the fourth quarter. We can't, because it was down about 20%. We came back up, went through the 20-week EMA. Notice when we pulled back, we held it. The weekly PPO was still rising at the last high. So normally what that means is when you pull back, you're going to hold the 20-week moving average and bounce off of it. So far, that's exactly what we're doing. So the weekly chart supports that longer-term secular bull market theory. Short term, and this is why I'm a little cautious right now and maybe just hesitating on some trades. Short term, we're down below the moving averages. The 20-day moving average is about to cross below the 50-day moving average. We're got another 3 points or so. Now, if we can get price action to get back up above these moving averages, then I think we've got the daily, weekly, and long-term all lined up bullishly. I will be much more aggressive. Short-term, though, I'm a little concerned until we get through that. So we might go back down, retest this level 2,800, who knows? But all of our major indices look like this right now. The daily PPOs are negative. We're below the 20-day moving average. The 20 is dropping, about perhaps cross below the 50. So that gives me reason for pause here in the very near term. All right, so step 2, that was step 1, figuring out the market, what I think about the market. So I'm going to be a little cautious near term, but if we get the breakout, I'm going to be back on, my foot's going to be on the accelerator again. Let's take a look at the sectors and industries, because which ones are leading and which ones are lagging. If we get a breakout on that daily chart, I want to be in the areas where the market is performing best. So when you look at this, first of all, this is just an intraday. And if you're not familiar with how to get to this, from the dashboard, under Member Tools over here on the left side, just scroll down. Whoops, went a little too far. Under Reports and Analysis Tools, here's your sector summary. So you click on that, and that brings you to this page. Now, this is just telling me one day. It's telling me materials. So if I just looked at this, I'd say, oh, materials, this is where I want to invest. Well, if you follow, and I'll go back over here and just show you the XLB versus the S&P 500. And let's go down and pull up the line chart. And let's go back here. I don't know, a couple, well, actually, we could probably go back several years. Let's go back 10 years and check out what's been going on here. Materials have been underperforming the S&P for a long time. We're almost at a 10-year low relative to the S&P 500. So yeah, you're looking at this intraday chart and you think, well, materials are doing well. I want to jump in. Well, as a swing trader, no, this is a group that really doesn't interest me. As long as the dollar keeps rising, and I showed you at the top of the show, the UUP was breaking out to a new high. As long as the dollar keeps going up, I'm not going to trust energy and materials on a relative basis. So for the most part, one exception in energy being renewable energy. That can be a very aggressive group and can move opposite energy. So I still like renewable energy, but outside of that, these two groups I'm going to ignore. So let's go back a little bit of time. Let's go year to date, because if you think about it, the bottom of the market came back at December 24th. Actually, I think maybe December 26th might have been an intraday move a little bit lower. So year to date pretty much tells us what the market has been doing. And if you look at what's been leading the market year to date, technology, communication services, industrials, consumer discretionary, and financials, the 5 aggressive groups are in the top 6. And real estate's up there, but I'm okay. When you look at, of course, materials and energy are down below, utilities down below, consumer staples down below. This is a perfect setup. And the recent pullback in the market has actually made this closer than it really is. For instance, if I look at a 1-month chart, healthcare, utilities, real estate, and consumer staples, all the defensive groups are leading. Well, the last month, the S&P 500 is down. Defense almost always leads when the market is down. What I'd be more concerned about is if the market was up over the last month and these groups were leading, because that would tell me that there's some serious rotation taking place while the market's going higher, and that would be bearish. But that's not the case. These groups are leading during a down market, which is fine. I don't get upset about that. Now, if the market rallies again next month, and we look at this a month from now, and the S&P's gone up 4%, and you're still looking at the same leadership, then I would be much more cautious the market. I don't think that's going to be the case. So if we actually stripped out what these sectors have done here over the last month, and we go back to that year to date, actually, let me go back one more time to that 1 month. So let's take healthcare or utilities, for instance, up 3.5%. So if I go back to the year to date, I know the last month it's up 3.5%. I could take 3.5% out of that. 1 month ago, utilities would have only been up about 9%, right? Technology, which is up 21%. If we look over the last month, technology is down 3.6%. So if we go back to year to date and we took out add 3.6% back, because a month ago, technology year to date would have been up 25%. Do you see where I'm going with this? These aggressive groups were way ahead of defensive groups. This is a perfect bull market setup. Aggressive groups leading, defensive groups lagging badly, but still going higher. Rising tide lifts all boats, wide participation, all groups higher, but the aggressive groups leading. Perfect backdrop. Okay, so now I'm feeling good not only about the market and the market type of market we're in, but I like what's leading the market. So what groups? Well, I'm just going to pick one. Let's just say, actually, do I want to get into this now? Yeah, let's take a look. Let's take a look at a group. I'm going to go with specialty retail and compare this to the S&P 500. And you can see on a relative basis, we had a huge move, 17 to 18 for about a year, sideways consolidating. But here in 2019, we've seen another big pop, and a breakout above 0.62, I think would be huge. And just telling us that, hey, this is a group that we want to be thinking about and maybe have some representation in. So you see this, you say, well, how can I use that? How can I use, specialty retailers? Okay, they're having a good time or good, period. They're breaking out on a relative basis. How do I trade that? How do I find individual stocks? Well, there are a couple of ways. I could go into the scooter reports, and let's say you want to trade large cap. All I have to do is, it's in scooter order. All I have to do is just type in specialty retail, and there are the specialty retailers. So if I'm getting a relative breakout, this is a real quick way to take a look at some of the stocks that are leading. Now, I would stay away from Tiffany's. I would stay away from Advanced Auto Parts. They've got look at the charts, just the thumbnail here down at the bottom. You can kind of see this little mini chart. But let's take a look at what CarMax is doing. CarMax is shooting up here. AutoZone, look at that chart. Alta, look at that chart. Tractor Supply, you can kind of see the difference between the high scooter scores and the low. Just like that, knowing what industry groups are performing well, if you're getting a breakout that quickly, you can go into large cap scooters and find the stocks that are leading. Now, there's other ways to do it. I have a strong earnings chart list, so I go in there and try to find stocks. Probably a few of these are in that strong earnings chart list as well. But you may have a watch list with 100 stocks on it or 200 stocks. You could go in and type just like I did in the list. So for instance, if I'll show you real quick on that strong earnings chart list. So here I go into my strong earnings chart list. This is how quick it's going to be. View all, summary, specialty retail. And there's the list in scooter order. FLWS. Now, this isn't a large cap, so that's why it wasn't on the list we were just looking at. But there's Alta. There's the large cap. Tractor Supply, large cap. So this is how I would do it because I have a separate list. But you can see how quickly you can use that information to find some possible trades. Now, what if you're an ETF trader? All right. One of the things I would focus on is when the stock market is strong, and I'm going to use this S&P 500 weekly chart, and I'm going to go back 20 years. When I say when the stock market is strong, what I'm referring to, actually, we could go back even 40 years. When I say the stock market is strong, the weekly PPO on the S&P 500 is above zero. That means the momentum is strong. So anytime that this PPO is above zero, I would tend to be pretty aggressive in the market. I'd be looking at the ETFs that track the technology group, the XLK, the XLY, consumer discretionary, the XLI, industrials, XLC, communication services, XLF, financials. I would stay completely away from the defensive groups because in a bullish market environment, they lag. You might say, well, I want some diversification. Well, I would only want the diversification if the weekly PPO goes below zero. Because at that point, now you're in a defensive market, and that's where I'd want to be weighting those defensive areas much more strongly. This isn't my style. I haven't gone back and back tested, but I have to believe that when the PPO is above zero, if you ignore the defensive groups and stick with the long-term performance of the aggressive groups, and then simply monitor, and when that weekly PPO goes negative, maybe you have some type of plan in place. Maybe you take all 11 sectors and just put 9% into each one, or maybe you weight it much more heavily toward defensive groups. Whatever you do, I think that would be a much better plan than simply riding the S&P 500. I think that plan would outperform. Haven't back tested it. Somebody would have to do that to see, but that's something I would think about as an ETF trader. When the market's strong, go with the aggressive areas of the market. When the market is showing weakness and starts to, bear market, you don't just start with a, you're not at the depth of a bear market as soon as the PPO goes negative. You normally are at the depths of a bear market a year after it goes negative. Now, these cyclical bear markets, they're going to whipsaw you a little bit, no doubt about it. So if we are in a secular bull and we stay in one for the next 10 years, you're going to get whipsawed when we get these little cyclical bear markets from time to time. You just got to know that's part of the game. But I would be disciplined with my approach, because if it does turn out to be a full-blown bear market, like a deep one, like we saw in 2000 to 2002, 2007 to 2009, moving away from those aggressive areas will likely save you a bundle. Okay. The last thing I do kind of from a big picture standpoint, and it really isn't big picture, I just don't do it daily, is I update my strong earnings chart list, usually weekly. So I normally will do that on Friday afternoon, because no earnings reports come out after the bell on Fridays. So the way I do it, I go into Zacks. I can come in here. Earnings calendar I use in my blog every day to identify the stocks that are reporting earnings before or after the bell. So for today, when I did my blog, I just came in here, sorted by market cap, and the bigger market cap stocks are the ones I list. Probably down to now, because there's not as many reports, I might go down to about 5 billion. When we get all those earnings reports out, sometimes I might only go down to 20 or 25 billion, because there are just so many companies reporting. So that's one way. Also, if you go into earnings releases, you will see sales surprise. So for May 21st, here are the ones that have the reported earnings versus expected revenues, and then here's your earnings surprise, reported versus estimate. So I'll get a lot of data off of here. That's where I get a lot of my homework. Okay, so let's move into the short term now. So before the market opens, what do I do? Well, the first thing I do, I write my blog in the morning. And so one of the things I do is I'll go in and look at Seeking Alpha, which I'll give credit here to Grayson Rose, who comes on the show from time to time. But Grayson suggested to me that I take a look at this from time to time. And I've actually found this to be a very, very good source of information. So you go to seekingalpha.com, and under news, click on Wall Street Breakfast. And I believe you can subscribe or follow this. But look at the just little quick tidbits of information of what's going on. Trade rows, weakening global economy, more central bank rate cuts, Brexit, Tesla-geddon. I'll talk about that more in a minute. That was unbelievable. But big cost cuts for automakers, footwear players, talking about the tariffs, mixed messages. This is the merger. But you see how quickly you get a lot of information about what's going on in the market. But notice nobody is saying buy it or, oh my gosh, this is going to fall apart, or they're just reporting the news. And so I kind of like that approach. I can make my own judgment based on, looking at charts and so forth. But this is a good way to start, just to get something brief. Zacks I showed you. Another thing I'll do is, one way to do it is just Google briefing in play. Hit the Google search and hourly in play. I do this every morning, and a lot of times in the evening as well. But if you do it today and you just scroll all the way to the bottom, it starts at 4 o'clock yesterday. So everything coming out after yesterday's bell. And these are just real quick little tidbits. Sometimes I'll just look at the ticker symbol. Sometimes I'll read the headline. And then occasionally I'll use it for earnings. So for instance, Nordson reported yesterday after the bell. They missed on earnings, missed on revenues. They also show me over here about their revenues versus estimates, so that I can get some information there. So this is another useful source. Then in the mornings, they come out and they'll talk about what's working in the morning, so I can get some news items there in addition to what I see over at the Seeking Alpha. I gave you the earnings report. So what don't I look at? CNBC. I do not use CNBC. Now, let me qualify that. CNBC I use in the morning, and I'm going to go over here. Let me show you why I use CNBC in the morning. So notice up here, little drop downs. I can get my pre-market real quick. I can look and see what's going on in the bond market, 10-year treasury yield, what's going on here in Germany with their 10-year treasury. Here's gold, silver, copper, oil, crude oil prices, Brent, natural gas. I get all of that. I know what happened in the major markets in Asia, and I know what's going on in Europe and the US. So very quickly, notice I'm not paying any attention to any of their analysis, which for me is about totally worthless. But this morning when I came in here, there was a huge headline, top news, and it was the Morgan Stanley news cutting Tesla, or not cutting Tesla, but saying Tesla, worst case scenario, could go to $10 a share. And here was the article. And they featured that at CNBC because why? Well, they want to scare the heck out of everybody. So they love these headlines. They love bringing Peter Schiff on. I don't know if you know Peter Schiff, but he's the perma bear who comes on and calls for a crash every month. And then once every 10 years, he's a genius. I just get so fed up with what they do at CNBC. They're looking for headlines. They're looking to drive ratings. And so I see this. I could have one-upped Elliott Smith, the contributor here. I could have said Tesla could go to zero because every stock in the market can go to zero. So I disagree with this could drop to $10. I think it could go to zero. Might as well post that, maybe get even more views. But that whole thing at CNBC just drives me crazy because I think that they're more important in driving ratings than they are about educating anyone in the public. That might be a secondary concern, not a primary concern of theirs. So CNBC, I do like that information that I get very quickly on the upper, part of their site. So maybe I'm giving them a little bit of a plug, but at the same time, this kind of stuff, these headlines literally drive me crazy. What they did here on CNBC was completely different than what they did on the Wall Street breakfast. They just gave you the same, it wasn't standing out above anything else. This was literally like right on their page, which again, they're focusing on what sells, which is scare the heck out of everybody. Okay, enough of that. So what else do I do? Well, I write my blog in the morning. That certainly helps me prepare for the day. I don't expect everyone out there to write a blog, but when I'm writing the blog, I'm looking at a lot of different things that happened yesterday. I'm looking at a lot of charts, and so that is very helpful for me to see what's going on in the market. So what do I do next? Well, that sector summary. As soon as the market opens, I'm in here and I'm looking at that intraday. I want to know what is leading the market. I see materials up, and the first thing I do is say, oh, all right, what's the dollar doing? And I saw today the dollar was up. I'm like, okay, material's probably not going to last. I know it's an underperformer. I could care less. Technology. Okay, market breaks out. I want to keep an eye on technology. What's leading? Well, if you click on technology, it tells you what's leading. Computer hardware, semiconductors, and then I can look at some of these groups, and I already know which industry groups I'm interested in keying in on. But I could go over here and just quickly take a look at the chart. All right, that one's dropping. That one's been dropping. All right, nothing looking very interesting here. Well, the computer services trying to rebound a little bit. Telecom, nice bounce there, even though technology and many of these industry groups have been going lower. Well, I know what the news is there. Cisco came out with their earnings. Look at software still outperforming. So yeah, software is down a little today, but this is still one of my favorite areas. But just clicking on the sector summary and then drilling down to these different areas can give me a lot of information about the market. All right, and then finally what I get into is I run scans. So if I go in here, let me show you a couple of scans I ran today. And I run just about every day. So I already have scans saved. First one I'm going to do is this 10 a.m. high volume. I'll show it to you, but I'm not going to run it right now. And the reason, well, all right, I will go ahead and run it. All right, 80 stocks in my strong earnings chart list, but my scan was anything over 40% of their normal daily volume. Now, I like to run this scan at 10 a.m. Eastern because you're only 30 minutes into the day. If I run this scan now, the problem is that most every stock, many of the stocks are going to be over 40% because I'm at the halfway point of the day. So that's why I have so many of these. So instead, let me go back and I'm going to pull up my 1230 scan and I'm going to edit. So now I've got, you can see this one is set up at 7.75. So now if a stock in my strong earnings list has traded at least 3/4 of their normal volume by essentially the midpoint of the day, that's more than normal. And maybe something I want to kind of focus in on. So let me run this scan, see what's going on. Now I have a manageable list, 14, and these are all trading more than normal volume. If I pull up the first one, check this one out. And you know what's killing me about this stock? John Hopkins and I were talking about the 3 portfolios that were mentioned, that we discussed in the webinar that I did at Earnings Beats on Sunday evening. I had 2 bios. I had 2 biotechs in my aggressive portfolio. This was the other one, and I took it out. And the stock is up 19% today. But the reason I liked it was, first of all, it had been declining, but the group had been declining. Look at the relative strength on Array Biopharma. So my point was that these biotechs eventually are going to catch fire, and when they do, you want to be with some of the leaders. Well, why has this stock been leading? Well, I can tell you why. Because they came out with news today, positive results from their colorectal cancer treatment therapy. Now, I don't know if there's insiders that already knew about the fact that, this was probably going to get approved. Maybe it's just because of the potential of this particular therapy. But for whatever reason, Array Biopharma was trading well above its biotech peers. And now today we get news and the stock up 19%. Of course, I don't own this one. That shouldn't be a shocker. Let's see, what else? So if I go back to that list somewhere, where did I have it? Oh, I know. I actually need to go back here. So there's Array. Cirrus Logic. I don't know what the news is here, but I can look at this one real quick. The scooter is only 44. I think it's maybe just a little bit of a rally off of, or at least an earlier rally off of some heavy selling to the downside. This is in that semi space. And I'll tell you right now, outside of maybe 1 or 2 AMD, maybe 1 or 2 others, I would stay away from the semis. And if the ones I was trading break down, no excuses, keep your stop in play. That's the way I treat these kinds of stocks. But another one on here was MRCY. Remember I mentioned earlier that they had the secondary price offering, or secondary stock offering. Well, the stock went all the way down. And so if I didn't already know the news, by running the scan at 10 o'clock, I would see heavy volume coming into this stock. I'd pull it up and I'd go find out what's going on. So it just alerts me to different things. And it might be a trade. I mean, this is a nice recovery. By the way, here's a stock that had a secondary offering after it came out with earnings back here in February. Next day, this is what I was talking about. You get earnings, get everybody jumping in. Next day, they come out with their stock offering. Didn't really hurt the stock. It just, you can see the sideways action for a while, and then it resumed its uptrend. But now I think that it's up to these stocks, especially if it's a lot of, if it's a lot of dilution. I think it's up to these companies to prove that what they're going to use the money for is actually not going to dilute earnings. All right, almost done here. Just maybe a couple of other things. Actually, what I'll do is go back to the scan, because you can see these are the other stocks. You know why T-Mobile's on here. Here's the other one, Verisight. This is actually on my aggressive list, and that one's up a little bit, 0.5%, not quite 19%, but anyhow. So those are stocks that just kind of alert me to heavy volume within my watch list on that particular day. The next list scan that I would maybe point out here would be RSI 40 to 50, strong earnings. I think I actually adjusted this to 40 to 45. No, still 40 to 50. Okay, so I could run this. All this is telling me is maybe stocks that have pulled back their RSIs between 40 and 50 on my strong earnings chart list. I'll run this. I'm not going to go through this. We're kind of running out of time here. But 48. So I've got that's probably about 20% of the stocks on my list. And by the way, now I've got this search table. I can quickly look and say, okay, any specialty retailers? Yeah, Five Below and Hibbett Sports. So I pull up Five Below, see if I like that. Well, nice little bullish engulfing candle on heavy volume. Moving back up, but I got the 20-day above. I probably wouldn't do anything with it. But that's just a way you can combine all these great features at StockCharts. But anyhow, that is, in essence, kind of how I approach the market every day. So here is my summary. You can read through the summary there. But I also want to bring up the poll real quick because we did have a number of statements in that poll that I think are important maybe to answer as you approach the stock market, just about your own trading strategies. And I was interested to see how many people use these different things. And the first one I'm very pleased with is that 90% of the respondents said relative strength is very important. 81% said big picture matters. 72% use a watch list. 56% watch earnings. 48% consider seasonality. I didn't mention that, but I actually had a note. I was just running out of time. But that's another reason I'm very, very cautious about buying right now. 19th to the 25th, historically, in calendar months is weak. So I might be looking a little bit more bullishly later in the week. And then the last one, I'm swayed emotionally by news opinions. I would have answered yes to all 6 of those. I don't know about you, Erin.
Well, I did, let's see. I was relative strength, big picture. Of course, I'm an intermediate term trader, so most definitely. I use a watch list. I don't follow earnings. I don't, because generally I'm an intermediate term trader, and I don't. I think it's a good idea. And then the seasonality and historical tendencies, I said yes, because like I did on upgrades and downgrades today, sometimes I just want to know what's going on with it as far as history. And I did not select swayed emotionally by news and opinions, because for me, again, being a little bit longer term time frame, I use it. It's noise to me. It doesn't, what happens just today or tomorrow is not as applicable to my trading style. That's all.
Mm-hmm. I get it. And the last one I think is a really big one. I just kind of threw that one in as a curveball. I don't think anyone's being honest here, to be honest. 19. I mean, I get swayed. If I see something, I get swayed, which is why I try to avoid seeing anything. I just like to look at the charts, because if I see something on CNBC and I'm watching them, especially when the market's going down, I can't imagine that there are those of you that out there that don't get so swayed when the market's gone down 8, 9, 10 days in a row and the VIX gets up to 30 and you turn CNBC on. Maybe you don't turn CNBC on, which is a good thing. But, there's just so much negativity everywhere that you almost have to get swayed. So that's where I'm coming from.
Sure. Well, and think about it. We talk trade wars. We talk about, the economic reports, of course. I look at upgrades and downgrades. I mean, I think that all of those are pieces of news and opinions right there.
Yeah, no doubt. All right. Well, we are running a little later, so let's go ahead and jump into the 10 and 10. But why don't you pull your RRG up if you have one ready?
Of course I do.
Of course.
That was a great, we got lots of great comments too, Tom. They loved your presentation.
Cool.
Mm-hmm. Okay, so here we go. Sector-wise, pretty much a mix of everything. We've got a little bit from every category, so I'll be mixing it up quite a bit today. And then as you can see there, sometimes we get a lot where everything looks like it's going northeast. Today, just looking at it, looks like there's a lot going in that opposite direction. So it'll be interesting to see what those charts tell us. Let's go ahead and get started with GWW, and everybody vote in the chat room so I know which is going to be the most popular for the next symbol.
All right, WW Granger. Don't like it. I think you're testing the 20-day from underneath. I would be a seller here if I owned it. You got a stock that's been underperforming its peers, and its peers have been underperforming. So you're getting a bounce. I think this is an opportunity to sell until we start to technically trade better, meaning getting above the 20 getting above the 50. and starting to see some relative strength, I'd avoid the stock, so I don't like it.
All right. Well, the most popular, and that would be Microsoft.
Yeah, Mr. Softy. Who doesn't like Mr. Softy? Great chart. And I've talked about this one in the past, but for those of you maybe that are new to the show, this is what I look for on my relative charts right here. It just doesn't get much better than this. We're seeing relative strength everywhere. I mean, the software group, I could go back probably 5 years and I'd be drawing a line straight up from left to right, software versus the S&P 500. So if you want to make money in the stock market, one of the best things to do is first start investing in areas that's outperforming the market. Because if you've got an industry group that's outperforming, you've got a much better chance of finding a stock that outperforms. So GW or WW Granger, GWW, the one I just looked at, was the exact opposite of this. You've got a poor performing industry group, a poor stock, and it's up against resistance. Here, you've actually got a stock in Microsoft that is consolidating. Looks to me like a little cup, maybe a handle back to the 20-day. You're in a great group. This has been a leader in the group. Between the two, there's no choice, in my opinion. Microsoft would be my pick.
All right. Let's go next with Carbonite, CARB.
All right. Again, I just don't like it. You're in actually a group in the internet space that had been performing pretty well, and relative to the S&P 500, the group's been performing well. But Carbonite, you can see relative to the internet group and relative to the S&P 500 has been poor. Now it is starting to come back up on a relative basis. So what I always say is if I'm looking at a stock and I like something about the chart and I decide I'm going to get in, if it is an underperforming stock, or if I'm in an underperforming index or industry group, then I want to make sure I keep my stops in play. And I don't know exactly how much room you want to give a stock like this, but for me, I would be looking at something, one of these things I'm drawing on this chart: the 20-day moving average, the recent price support, the more intermediate term price support, maybe relative strength. Because if I see the relative strength on this stock relative to its peers, which has started to strengthen, I'm already seeing a little bit of a hook. And we struggled for 3 months getting above this level right there. You can see all of these relative resistance lines, or this relative resistance line, tested on multiple occasions. We seem to be rolling back over. I don't know if you're looking at this as a change in character because we had the downtrend, we gapped up to a multi-month high. I would just say keep your stops in play in the event that it rolls back over, because you have an underperformer looking at the longer term.
Okay, let's see. You talked about Tesla and that news, but did we look at that chart in detail?
No, we did not. So let's look at it. Yeah, I could I'm gonna actually cheat a little bit, just go a little bit further here on Tesla. I want to go back a few years. We'll still leave the relative strength up here, but I wanted to show this because I think that was a big breakdown. I thought we had an uptrend in Tesla for quite some time. Resistance, overhead resistance at 385. The support, I mean, I don't know, you could draw a line there. Maybe you could draw a line down here where you got this low and this low. But 245 to 255, I'd say, was pretty good support. Resistance at 380, off of an uptrend. I was waiting for the breakout, and I remember back in December, I was bullish Tesla. I thought we were going to get the breakout. I wanted to see the breakout, but we never got it. And we ended up coming back down, and now we've actually broken to the downside. I think the stock's got a lot of problems. Short term, I wouldn't be shocked to see it move back into the 240, 250 range. But I think the longer term support around 180 is going to come into play. I'm just not a fan. And it could come into play first. I mean, if I thought we were going to go to 240 first, then I'd probably jump in. But I'm not so sure we don't go to 180 first. I don't like Tesla here. I'd avoid it.
All right. Let's see. TJ Maxx Companies, TJX.
All right. TJX. I don't need that weekly chart. Yeah, they just reported earnings, by the way. Stock was way down, and this is why I personally don't like to trade going into earnings or the day of earnings, because look at this long tail. Looked to me like it was a breakdown. I probably would have gotten stopped out and then stock would be $2.50 higher a couple hours later, and I would be ready to jump out a window. So I, wouldn't particularly trade a stock that is reporting earnings or maybe just reported. I like to see these stocks settle down a little bit. Now there is one good thing that I like on this chart, and especially with the recovery that we're seeing today, and that is, again, look at the relative strength. Looking at TJX versus the apparel retailers, you have one of the best stocks. It gaps up with earnings. It goes down, I think probably triggered stops to accumulate shares. This was probably manipulation by market makers that have orders from institutions to buy. And so the best way to buy is to create a breakdown so that people like you and me will sell to them. And that's what this looks like to me, a reversal. So I actually like this stock on this reversal. I suspect we'll make a run for those highs back in 2018, maybe up here around the 55, 56 area.
All right. Let us look at, let's see, EQT. And that is exploration and production.
All right. Don't like the group I mentioned earlier. I just don't like energy unless it's renewable energy. I'm just not going to be a fan. And renewable energy is very aggressive. So most folks probably not a great idea there. But you can see again versus the S&P versus the group. I mean, it's not been horrible versus the group, but look what the group's been doing. The group's been going down versus the S&P. So even if you're middle of the road versus your peers, do you want to be part of this? I'd say no. So the only types of stocks I would consider in this group would be stocks that are showing 52-week highs on a relative strength basis. And even with those, I would be using pretty tight stops. I think the key area of resistance on the chart is this gap resistance. We've been up here multiple times, haven't been able to get through. Let's get through 22. Let's see some relative strength, and then maybe we'll look at it again. Until then, I say no.
Okay, how about Novocure, NVCR?
All right. Looking like a little bit of a cup maybe forming to me. It is in the medical equipment area. It's near. It actually set a 52-week relative high just a couple months ago, and it is uptrending again. So there are some positives here. I'd like to see another breakout on the group relative to the S&P 500 rather than drifting lower. So that might be something to look at from a group perspective. But as far as this stock goes, I mean, what I'm seeing is what could be a nice little cup off of an uptrend. So, and as long as we stay above this 20-day moving average, I think that I would be okay with it. So maybe also put this in there. But you can see these 20-day tests. So if we get another one in here somewhere around that 48 level, I would look for it to hold. Because the overall group is a little so-so, this is a stock that I would keep a fairly tight stop on.
All right, let's see. Next one up is going to be Dow DuPont, our only materials request, DWDP.
Awful. I would just say, I don't even need to annotate this, but I mean, just look at this disaster down here. The group relative to the S&P 500 is just getting absolutely trashed, and you've got one of the worst performers in the group. So then you look at the chart, you've got a price breakdown, you're rallying, the volume is dropping on the rally. I would imagine you're going to struggle if you get back to that area or the 20-day moving average. So I would be using this strength to sell. I'm not a fan.
Okay, let's see. Next one. This was a Monday setup of mine, and I actually am holding it. So I'm just going to say that right now. And another one of our viewers was asking about it, Model N.
Yeah, I mean, the gap up was certainly nice. It's come back, I think, still holding gap support. So I'm still pretty bullish there. The overall group hasn't been bad. And this is one of the things I was talking about. So the overall group has been drifting lower, but the stock is showing a lot of leadership. So for me, I would just make sure I keep my stop in play. I'm okay trading stocks that are in groups that maybe aren't among my favorites, but I want to make sure that I honor the stop. I think you got a nice gap up here, big volume. We're working our way back, still holding support and our gap support. And then you've got this 50-day moving average. So I'm going to say that the combination of the 50-day and gap support If we closed below that, because of the relative weakness over the last 4 months in the group, that would probably take me out of the stock. I don't want to take a chance. If the group's weak and I start making technical failures, I fail to hold support, I don't want to make too many excuses for a stock if it's in a group that's not performing well. So I'm okay with it now on the long side, but I'd keep a fairly tight stop here.
Yes, and mine, let's see, the viewer had an $18 one, I believe. I'm at a $17.70 stop. So,
okay.
All right, next one up, and our last one is EVBG.
Oh, yeah, this was in my aggressive portfolio. Software. So first of all, I love it because it's software. Second of all, obviously, I love it because I put it in my top 10 stocks for an aggressive portfolio. And by the way, if you have any interest in that, if you want to hear that, actually, you can always sign up for a 7-day trial or 30-day trial over at Earnings Beats at $7. But I did a webinar. John Hopkins will send you the copy of the webinar. It's probably an hour and 20 minutes. But I unveiled 30 stocks. I did an aggressive portfolio, an income portfolio, and a model portfolio. And all of those stocks came out of the strong earnings chart list that I use. I just picked basically my favorites in each of those categories. Anyhow, Everbridge was the aggressive stock that I used out of the software space. I loved the volume that's coming in here. And by the way, I had a lot of choices in software, but I love the volume that came in on this last breakout. I love the fact that the stock versus software made a new high. So you got a great group and you got a stock making a new relative high. One word of caution, it is a small company. So this is you can see the stock was looking really good back in April, and we had a pullback here probably of 12, 13% in 3 weeks. So, somebody who's maybe risk averse might not like a stock like this. Somebody who is looking for return, higher return, and might not care about the risk, I would say this is a good stock. I actually like this pullback. I think the further it pulls back, the 20-day I'd really like on EVBG. But anyway, if you're interested in that webinar that I talked about, go into earningsbeats.com. There's a link to top 10 picks webinar or something like that, top of the page. Anyhow, if you follow the link there to signing up, John will send you a copy of the recording. That was a really fascinating webinar. And anyhow, there you go. There is the 10 in 10, as you can see.
Yes, I will have those up in the Market Watchers Live recap and live chart list. Just go to the articles tab, click on Market Watchers Live, and you will see that link at the top. I will be right back with the final market update after this.
Market direction is the single most important thing all investors need to know. Get the advice you need by joining dozens of elite money managers and financial experts, including Steve Forbes, Paul Merriman, Tom McClellan, and Keith Fitzgerald at the Money Show Seattle June 15th and 16th. You'll hear real-time market analysis and learn which stocks, bonds, funds, and commodities you should buy and sell to build a safer, more profitable portfolio. Claim your free pass at seattlemoneyshow.com.
And now it is time for our final market update. As you can see, market's all up right now, pretty much. Excuse me. Dow gapped up and is moving sideways. You can see similar action for both the S&P 500 and NASDAQ. Nice gap. And actually, it looks like we're on a rising trend continuing here for the NYSE. Russell 2000, small caps, really nice day, popping up. Looks like forming an intraday flag. We should hopefully see a continuation. Notice that if this is a flag formation, you got the breakout, the minimum upside target would really bring you right back up to what we saw back on Thursday as far as a high. TSX, Canadian markets are mostly unchanged right now. Treasury yields are higher, reading 2.428%. Volatility index is falling lower and has been staying right between 15 and 1550, currently at 1509. UUP is up a little over 3 cents, 26.36. Gold, GLD, not surprisingly, seeing that one down a little bit right now, down to 120.16 currently. USO, down, but making up some of those losses that it had earlier in the morning. TLT, big move to the downside, but it, just like USO is starting to cover up those losses. We should hopefully see it get to the positive territory soon. Let's look very shortly at this sector summary. And as you can see, let me go ahead and make sure this is as up to date as possible. Yes, materials are leading right now, up almost 1.5%, followed by technology, 1.3%, and consumer staples, the only sector today in negative territory. That's all I have for the market update. Tom, do you have a quick chart for us?
Sure. I'll just take a look at the S&P 500. I think I covered just about every time frame possible except the hourly chart, so I might as well put that one in here today as well. Yeah, I'm looking at this still as a possible. I'll just annotate it very quickly, but I'm still looking at the S&P 500 on this hourly chart as possibly a reverse head and shoulder. So here you're moving lower. You put in this low. You come back up and establish the left side of the neckline. You go down to a lower low. Rally back, put in the right side of the neckline, come back down. Look at this left side, right to 2830, almost exactly where the left side is. So we got a pretty symmetrical looking reverse, a bottoming reverse head and shoulder pattern. And now we're starting to move back up off of it. I believe a move through 2890 and especially 2900, because that's where we broke down below this prior low. I think this is going to be a critical area for the S&P in the near term. I believe if we break out, we're going to go to all-time highs. I think we'll go back up and take out that May high and probably move back above move above 3,000, not back above. We haven't been there yet, but I think we're going to go above 3,000 in 2019. And so this would be the first step on the short term, getting back through this area around 2890 to 2900. Okay, we are going to go into our final segment, Scooter Report. And Erin, I'll let you have this segment. Go ahead.
All right, here we go. I'm going to look at Biotechs in particular today. As I had noted in the upgrades, downgrades section, Credit Suisse initiated coverage on 7 major biotechs. So I thought it would be interesting to do our Scooter Report with a focus on the biotechs. So I'm going to just take you first to our Charts and Tools tab, and that brings you right here. If you come down, you can get to the Scooter Reports, the summary pages. I just click right there. Now I want to look at Biotechs first and foremost as far as the Scooter. So I'm just going to search the table. And there we go. There's a list of the major biotechs, and I can rank them by the Scooter. And this will give us a very interesting look if we just go through these particular stocks. However, I wanted to show you just another way to do this. And that was, I came to the dashboard. I actually want to create a scan because I want to look at more than just those major biotechs. So the way I did this, and all I'm doing is just finding those, but I want to have a decent volume, because a lot of times when you do the look at some of those reports, you end up with a lot that have pretty low volume. So I'm going to, and they're very volatile stocks anyway. So I'm going to go with the 200,000 as my list. And all I need to do is find the biotechs, which are down here under healthcare. And I just click add. And there you go. I have the group that is the biotechs. Let's just see how many are in there with this kind of volume. Actually, I also want it to be a price. I don't want it to have a price that is too low. So we'll make the close. I want it greater than, well, $9.90. Let's do that. So when I run this scan, how many do I have to look at? 102. All right, well, since we're doing this by Scooter, I think rather than look at all of these really beat down stocks with Scooters that are very low, I think what I'm going to do is look at them with a Scooter that is above 70. So let's go ahead and add the Scooter in here. There you are. This says 90, but I'm going to lower that to 70. And now let's run the scan. There we go, 33. I can do 33. Not that we'll look at 33 stocks in the next 6 minutes, but we'll pick some that look interesting. So I'm going to move these, not in my watch list, into my scan dump. This is my completely transient chart list. It always is changed probably 10 times a day. So I know that there's nothing in here that I want to keep. So that's why I always move it to my scan dump. So looks like some pretty interesting names in here. So I'm going to go ahead and look at them in Candle Glance, because Candle Glance is really probably one of the tools on the site that I use, well, every day. I have set up my own Candle Glance style so I can see the 20, 50, and 200-day EMAs. And of course, I have my PMO on here. So this really is my quick and dirty, like, look at this. I can get a quick bead on the ones that look interesting to me, and I can go right on in there. If I'm really looking to keep this chart list, trim it down, I can always use these trash cans for any that don't look interesting to me. All right, so, okay, that has a huge 21% gain. I don't want to look at any of these really with such high gains, because likely we're going to see a pullback when that happens. So let's see. This one has an interesting look, a little bit too parabolic for me, and in the biotech space, I would be worried about that. This looks interesting, and this is bold, B-O-L-D. And I thought it looked interesting from my Candle Glance. Just in the short term, I'm seeing a rising and ascending triangle. And notice the PMO is starting to turn up. You have the OBV going in the right direction. So let's annotate this one very quickly so I can show you what I'm talking about as far as that triangle. So you have a rising bottoms on the low side here, and then a flat overhead resistance line. Just getting ready to execute this. I would do my measurement back here. It's about $45. That looks like a reasonable upside target. This one would be great for a watch list, I think. So there you go. Nice scooter. Since we're talking scooter, it's been in that hot zone above 75 for quite some time, since March. So this one looks pretty good. Where were we? Let's go back to our Candle Glance. View all. All right, let's see what else is just going to pop its head out at me. I'm going to peek at the PMO. What are our breakouts? That's sort of a flag, but the symmetrical triangle. It is a continuation pattern. Let's look at Fate Therapeutics. I'm just curious. Okay, so here you have the overhead resistance at $19. We poked out above that, starting to pull back toward the short-term breakout point, which was right here. It broke out. There you go. And it's coming back to test that breakout point. We could see that rebound. And as I was saying, in the very short term, that's a symmetrical triangle. That is a continuation pattern. You could make a case for maybe a flag with a flagpole pennant formation, but in any case, it is a bullish formation. $19 though, it has to get above $19 or I'm not going to buy it. It is a biotech. They're very volatile. I would want to wait for that breakout back up to go test that $20 range. A $1 move to the upside would be a tidy little sum. All right, back to our listing here on the Candle Glance. Well, let's see. And this is definitely real time. Okay, maybe another ascending triangle here, and it looks like an improving PMO. The 50 is above the 200-day EMA. We are on a neutral signal, but let's go ahead and give this one another look here. This is Ionis Pharmaceuticals, IONS. And is that really a ascending triangle? Let me get my handy dandy annotation tool out. If we count that low, which I think we should, rising bottoms, you can see those three tops really form the upside resistance here at the top of this ascending triangle. PMO is getting ready to turn to the upside. I would like to see some volume here today to the upside that might get this OBV to get out of this little zone it's been in. So if you get the pop on the volume along with the breakout here, this one I think would be really interesting as well. That is IONS. So hopefully, like I said, I'm going through these, I'm looking and boom, there's one that looks interesting. That's really how I do my selection, just because I'm looking. There's just certain criteria. Like, for example, this isn't something, it looks like a flag here, but my PMO is overbought and getting ready for a sell signal. Yes, the EMAs are all lined up. Like I said, but why am I going to get involved with a stock that is overbought and a PMO that is moving lower? I'm not. So let's go ahead. What others maybe look interesting? That might be a short-term double bottom, I suppose. Let's look. It is on a PMO sell signal, but the PMO is starting to decelerate. Yeah, I think you could make a case for a short-term double bottom here. You'd have to get up here to 1550 to execute it, to make it a real pattern. That's your confirmation line at 1550. It's above the 20-day EMA today. It's trading above it. If we get a close above that, could be an interesting one for the watch list. Yeah. All righty. And I think that's really all I wanted to cover as far as a scooter report on the Biotechs. But really the scooter report was how I just got to this place to look at these stocks, to get the ones that are longer and intermediate term looking better. So, the scooter is helpful as a tool just to see how the stock is doing, but because it's a relative strength tool, it works out excellent that way. And here is the summary of what I just covered. Get in there and check out the scooter report as is, and do those searches, try those scans, create a few. Get in there and have fun.
All right. Well, that brings us to the end of my birthday show.
Yes, I know. It turned out good. Like I said, I think the markets are certainly cooperating for you.
Yeah, I'm pleasantly surprised by the market today. I thought when we got the lift at the open, I wondered whether or not we would sustain it. And I'm still kind of wondering it, but we are, as you can see right now, Dow Jones up 172 points and NASDAQ up 87. And so you go across actually, just under 87 on the NASDAQ, S&P 500 up 25. And the Russell showing a little bit of leadership today, up 18, up 1.2%. So it's good to see some bullish action, because the market has been very choppy of late. But I do like the fact that the volatility index has been coming out of the market.
Yes, absolutely. And seeing the small caps there, leading the way with a bigger percent gain right now. It's good news. Want to see that.
Yep. And anytime you get this, where you get that pop in the volatility index, that normally marks a pretty significant short to intermediate term bottom. And now that we're seeing the day after day, the VIX just keep going lower, I think that we put the bottom in, maybe for the next few months. We'll see.
That would be nice.
Yeah. So let's see. You already had your birthday, right?
I did back in January. Now, if people remember that blood red moon, that happened on my birthday, and the very next day, the market took that first dive in 2017. So I remember I was out, and I decided I can't go out for my birthday.
So your birthday, you had the blood red moon, and for my birthday, I just get the blue moon.
Yes. Here, cheers. This one's for you.
Thanks. All right. We need to wrap up here. I do want to thank all of you for being with us today. Please remember to complete the survey as you exit. It's located below your video player. I'd love to get feedback, actually, hear what you thought of today's workshop. So feel free to fill that out if you don't mind. As a quick reminder, Market Watchers Live airs 5 days a week, Mondays through Fridays from noon to 1:30 p.m. Eastern Standard Time. Have a great Tuesday afternoon, everybody, and we will see you back here tomorrow. Happy trading.